Hey, let's be real for a second. Are you secretly terrified that the money you're working so hard to save is literally losing its value every single day? Well, if so, you're definitely not alone. It's a completely valid anxiety, especially in today's economy. But what if I told you that you already have the power to protect your savings? Even better, you can actually multiply your real-world buying power. Welcome to This Explainer. Today we're serving up a mentor's step-by-step blueprint to compounding your wealth in the Pakistani stock market. We're taking an 8-year investing journey and simplifying it into actionable, crystal-clear steps. All right, let's dive right in.
Here's our roadmap for today. First, we'll cover why you must invest. Then, how stocks actually work, 3 ways to invest, your pre-investing checklist, and finally, the long-term mindset. All right, Section 1, why you must invest, the hidden cost of doing nothing.
You know, we often think that leaving our money safely tucked away under a mattress or in a bank account is the most responsible thing we can do. But actually, it's incredibly risky. And that's because of an invisible tax called inflation. Take a super everyday example, right? An egg. If you buy a single egg for 35 rupees today, next year that exact same egg might cost you 40 rupees. No way, right? But those 5 extra rupees, that is literally inflation in action. Your money hasn't physically disappeared, but its purchasing power is dropping daily. If you don't invest to outpace this, just maintaining your normal everyday lifestyle is going to get harder and harder.
Let's look at the real stakes over a 20-year stretch. Say you have 1 lakh right now, and let's assume inflation averages about 10% a year. If you just keep that cash hidden at home, well, in 20 years, it'll still look like 1 lakh, but its actual purchasing power, it plummets to a shocking 14,343 rupees. You won't be able to buy anywhere near what you could today. But wait, check out the flip side. If you invest that exact same 1 lakh and it grows at an average of 17% over those 20 years, it explodes to about 23 lakhs. Even after factoring in that 10% inflation, your real spendable value sits at 3,43,000 rupees. So, compounding doesn't just protect your money, it literally multiplies your buying power. It's an absolute game changer.
Moving on to Section 2, how stocks actually work, the National Foods ketchup analogy. So now that we know why we absolutely have to invest, let's demystify the market using something sitting in your kitchen right now. The crucial point here is understanding what a share actually is. When you buy a share, you aren't just trading some random digital ticker symbol on a screen. No, you are buying a unit of minority ownership in a real underlying business. You literally become a tiny percentage owner of a massive company. Okay, so how does this actually build into real wealth? Imagine you go out and buy shares in National Foods. Step 1, you are now a minority shareholder. Congratulations! Step 2, consumers go to the store and buy more of their favorite National Foods ketchup. Step 3, because of those sales, the business grows and becomes more profitable. And Step 4, as a direct result of that business growth, the value of your shares increases. A successful business directly puts profits into your pocket. It really is that logical.
All right, Section 3, 3 ways to invest. Choosing your investment vehicle.
So, we understand the why and the how. Now, how do you actually put your money into the market? In the Pakistani stock market, you generally have 3 distinct avenues to choose from. We've got mutual funds, ETFs, which stands for exchange-traded funds, and individual stocks. Each of these vehicles operates a little bit differently, so let's break them down real quick. First up, we have mutual funds. Here, you just transfer money from your bank to an asset management company, or AMC. A qualified professional manager pools your money with a bunch of other people's and handles all the actual investing for you. Pretty easy, right? But because they do the heavy lifting, they do charge a yearly fee, usually around 2 to 3% of your portfolio. Then, on the other side, we have ETFs. Like mutual funds, they're a basket of different stocks, but to buy them, you actually need your own brokerage account. The trade-off here? Because you're buying them on an exchange yourself, the fees are generally much, much lower.
But what if you want to buy those ETFs or pick your own individual stocks? Well, you're going to need a brokerage account. And don't worry, opening one is literally as simple as opening a normal bank account. There's an easy account, which only requires your CNIC, but it does cap your investments at 10 lakhs. If you want to go beyond that, and hopefully you do, you'd open a normal account. For that, all you need is your CNIC, a salary slip or some proof of income, your signature, and a picture of your checkbook. Once you're approved, you just transfer the money, and you can buy shares right from your phone. Super simple.
That brings us to Section 4, your pre-investing checklist, the crucial safety check. Okay, hold on. Before we rush off to open an account, we need to lay down a few strict rules, because this explainer is all about responsible wealth building, not gambling.
These are your two absolute gatekeeper conditions. First, you've got to clear all high-interest debt, like credit cards. Look at it this way. If you're making a 15% return in the stock market, but you're paying a 30% APR on a credit card loan, you're just losing money. Pay that off first. Second, you must have an emergency fund covering 3 to 6 months of living expenses safely stored away in cash. Why? Because if an emergency hits and you don't have cash on hand, you're going to be forced to withdraw your invested money early. You could potentially take a loss, pay capital gains taxes, and completely kill your compounding momentum. And nobody wants that.
And that brings us to the absolute golden rule of investing. Any money you put into the stock market must, and I mean absolutely must, be funds that you do not need for at least the next 3 years. Nobody, and I mean nobody, knows what the market is going to do tomorrow or next month. But over a multi-year horizon, it has historically given the best returns. Basically, patience is mandatory.
Finally, Section 5, the long-term mindset, navigating the journey. You know, building wealth isn't just about the math. It's heavily about psychology, resilience, and strategy. This is especially true for the millennials and Gen Z investors who are actively driving market changes right now. So, here's your essential mindset toolkit. If you're a beginner, stick to index investing. Buying into the top companies of the KMI 30 or KC100 index lets you grow with the overall market while you take the time to educate yourself. Next, manage your expectations. Every economy has boom and bust cycles. You've got to mentally prepare yourself for both the bull runs where everything goes up and the bear runs where the market pulls back. A really great pro tip, watch interest rates. When they go up, stock market growth usually slows down, and vice versa. And finally, if you're concerned about religious compliance, please note that the stock market is not inherently a gambling or interest-based activity. There are specific Sharia-compliant companies vetted by a Sharia board, which gives you total 100% control over exactly where your money goes. Also, remember you don't have to throw everything into stocks right out of the gate. A really smart beginner strategy might be investing just 40% of your life savings into the stock market. You can easily diversify the remaining 60% into other assets, like maybe gold or Sharia-compliant money market funds. By creating this kind of diversified basket, you can intelligently adjust your strategy as the economy naturally shifts.
I love this quote. Delayed gratification can take you to places you can never imagine. Building a portfolio requires continuously feeding it with your active income over 10, 20, or even 30 years. It is definitely not a get-rich-quick scheme. But honestly, if you put in the time, patience is practically a superpower in the stock market.
The absolute key to achieving that delayed gratification is what we call personal agency. That's the vital ability to just figure things out for yourself. If there was a term in this explainer today that you didn't quite grasp, say balance sheet, cash flow statement, or exactly how the fertilizer sector works, write it down, Google it, ask an AI. Fear of the stock market really only exists until you understand it. When you use your personal agency to do a little research, the light of knowledge instantly eliminates that fear. So we've broken down exactly why you need to invest, how the market actually works, the vehicles you can use, the safety checks to clear, and the long-term mindset you need to adopt. You've got the blueprint right here to protect your hard-earned money. So the only question left is, are you ready to take your very first step and finally defeat inflation? Thank you so much for joining me for this explainer, and I highly, highly encourage you to start putting this knowledge into practice today. You've got this.